Well, good morning or good afternoon to everyone, depending on what part of the country you are calling in from. My name is Ginger Bell, and I will be leading us through our Trends in Compliance webinar series today. And today we're going to be talking about QC trends. So as we get started, I want to cover some housekeeping items. First of all, we do have all of you muted, unfortunately, so we can make sure and listen to the material we're covering today. But if you do have questions, we want to make sure and address those. So you can type your question in the question box on the GoToWebinar screen. And let's go ahead and test that out right now. And if you can type in there what part of the country you are calling in from, that way I know that you all can hear us and it's not just Theresa and I having the conversation here. Let me know how your weather is too. I am in Portland, Oregon, and yes, it's raining today. Theresa, I know you're in San Diego, where it's always sunny.
Yep.
But we have had some beautiful, beautiful fall days here in Oregon, and the leaves are changing, so I love this time of the year. And so I see you're typing in there from across the country. Looks like it's beautiful across the country, which is good. I have to go someplace else. I'm actually going to be in Las Vegas next week at the American Association of Asian Realtors. They're having their national conference in Las Vegas. And so interestingly enough, as you all are getting logged in here, I'll give you a little side note, because I was surprised when they called and asked me to speak that about a third of their members at that association are actually lenders. So, you know, if you're not a member of like the American Asian Association of Realtors or the National Hispanic Association of Realtors, that might be something good to consider. That's just a side note, bonus information. So I did type in there, if you were logging in, you'll see on your information, we did put the material, and it's located in the handout portion of the GoToWebinar screen. It's on your, should be a blue panel. And so you can go there, you'll need to click on it, and then open it up, and then you can download that onto your computer. If you want to print it off, you can print it off. If you want to save it, you can save it, but that way you have access to that. We are also recording this session, and I'll be following up probably tomorrow with an email with access to the recording as well as this handout. And so if you have somebody that was not able to attend or you want to listen to it again, then we will have that recording available for you tomorrow, and I will send that out in an email to everyone who registered to attend the webinar today. So I'll take a moment and introduce our speakers. If you've been on our webinars over the past several months, then you know who I am. My name is Ginger Bell. I'm an education specialist within the mortgage industry. Have been developing compliance, sales, coaching, mentoring. Now I'm getting into millennial training programs for the past 12 years. I work with a variety of lenders across the country, and I also work with SEP on their training program. And with me today, I have Theresa Ballard, who's a longtime friend and expert in the industry. Theresa currently serves as compliance consultant for Strategic Compliance Partners. She works very closely with state and federal auditing agencies, and she's also acted as an advisor to several state and federal agencies, including the CSBS, ARMOR, and the NMLS. Theresa has worked doing compliance audits, post-secondary closing audits, loan delivery, and loan guarantee services, and she is definitely the go-to person when you want to talk about anything that has to do with QC. So we have one of the very best in the industry with us today for this webinar. So we started doing our Trends in Compliance webinar series a few months ago, and each month what we're doing is focusing on a different area of compliance. And so obviously today we are focusing on QC trends. Next month our topic will be HMDA changes, and I know there was information out from the CFPB just today. I haven't had an opportunity to take a look at it yet, but we will be having our compliance consultants at SEP delivering that information, and that will be next month, Thursday, November 10th. And so you can click on the link on the slide deck in the handout to be able to register, and then I'll also send up a follow-up email. I'll put that link in the follow-up email with the recording as well. So let's get started. As we were preparing this information, Theresa and I kind of went through and said, okay, let's do this out. And I always love the top 10 list. It's something that it makes it easy to understand. So we just actually put this into starting out the discussion of the top 10 reasons for a QC plan. So Theresa, I'm going to turn it over to you, and we're going to actually do this in the proper top 10 formality form, and we'll start out with number 10. So Theresa, number 10, top 10 reasons for a QC plan.
Okay, thank you, Ginger. Yeah, we're going to play David Letterman. I always liked his top 10 lists. But anyway,
Exactly.
As far as the top 10 reasons for a QC plan, one, it's going to keep the senior management informed and involved. That's really a very important aspect that we wanted to make sure that management knows what's going on at all levels. And then we've got on number 9, we've got, you're going to provide a comprehensive and proactive risk management. And that the optimum word there is proactive. You want to have that risk management approach to strengthen your loan performance and ultimately reduce loss and reducing costs. So that's one of the major reasons. And then you're going to be monitoring and evaluating the integrity of your origination process. And what we're talking about today on this particular webinar is we're talking about the origination QC. We also have for those who are servicing, you've got to have a servicing QC plan, but that's another topic for another day. So what we're really talking about today is the origination process. So the plan that we're talking about is the origination piece of it. Number 7, you're providing feedback to everybody within the organization. It's how are we doing? What are we doing? How are we doing it? It lets everybody know in the company what's happening in that origination process. And most importantly, one of the important features is it's ensuring compliance with the agency requirements, with your investor requirements, and then also with your corporate policies and guidelines. Is everybody doing what they're supposed to be doing? And that's something that you have to keep track of. For number 5, it protects your company. It protects your company, your investor, and your agencies from unacceptable risks. Everybody has their own level of risk, but you as well as I do know that the agencies have a level of unacceptable risk. So the QC plan or the QC process protects you for that. And then on number 4, it guards against errors and omissions and negligence and fraud. Most people when they think QC, they're saying, okay, well, we're looking for fraud. And that's not necessarily the case. We're looking for errors. We're looking for omissions. We're looking for negligence. Those 3 issues don't necessarily equate to fraud, but you want to know about them. The other big issue that you're looking for is the root cause of any kind of deficiency that you're seeing. You want to identify the potential of any kind of internal or external control weaknesses. And you want to know what's causing that. Why are we seeing the issues that are cropping up? And then that could go back to a training issue. So, and then we're looking at you're ensuring the existence of the required documentation. Time and time again, most of the issues that are found in the QC review are that the documents were just not available, they didn't get scanned, or they weren't properly completed, or they weren't done. The biggest issue, hot button these days that we're seeing is verbal verification of employment. They have to be done, so you have to have them in the file. That's a big deal. Alerts to management. It tells management of any kind of patterns that are being seen with the deficiencies, whether it's in the process or with personnel. And that's the most important thing. Management needs to know what's going on at all levels of the company. So let's look at what are the benefits of the QC plan.
So, and we move on to that. That's really the thing after taking the top 10 reasons. Now let's look at what the benefits are. And beginning with your QC plans and your evaluations, question is, to you, Theresa. How does a QC plan ensure that mortgages are secured by properties with value that's sufficient to support the mortgage?
Well, and that's a good question, because you think about it, what's the collateral for the mortgages that we produce? It's the property. So we want to make sure that the value of that property is sufficient to support that note. So you're doing this through the QC. Yeah, we're relying on the appraiser, but we also need to have a validation of that appraisal. So, and that's done through desk reviews. It's done through field reviews. It's done through automated valuations. So there's a process. How do we know what we're are we just getting a pig in a poke? It's just, you want to know what the collateral is that you're using to support the mortgage that you're doing. So again, through desk reviews, field reviews, and automated valuations. That comes into play with the QC.
Absolutely. And then, of course, we cannot forget about fair lending. So how does a QC plan ensure compliance with fair lending laws, including the Fair Housing Act and ECOA?
Well, the biggest thing here is really looking, again, you're looking at a granular level, on loan level, and you're looking at your processes. You're evaluating that compliance with technical and non-discriminatory actions. You're looking for, is there something going on that could evidence any kind of discriminatory practice? And basically, nip that very quickly. You're looking at documentation. Was there any sort of sign of any kind of discriminatory practice? You're also looking at adverse action. Why was the loan declined? What was the decisioning that behind that? And adverse action review is part of the QC that has to be done. So looking at why a loan was declined and making sure that no discriminatory actions were accompanying that.
So, and looking at all that and pulling it together, there's obviously timing that goes into QC. So let's start at the very beginning at application and talk about what QC needs to be going through and what you should be doing for QC at application.
Well, the QC process really begins before the application is even taken. So because you're setting the process up. And you're looking at it from the application through the life of the loan. Basically what's happening is that you're looking at it from the standpoint, did everyone do what they were supposed to do when they were supposed to have done it, and did they do it in the manner that's dictated by your company? So it's just going behind. You're playing the mom, making sure everybody has done what they were supposed to have done. And that's why it really begins at the very, very beginning, and it just follows it through the life cycle of the loan.
Right. So then we take it from application and we go through and then we look at our pre-funding and post-closing differences. So what is pre-funding and or pre-closing and post-closing QC?
Well, and this is a hard thing because pre-funding is relatively new to our industry. We should have all been doing it for agent managers, but we haven't, and now it's really coming to the top. And just like any kind of manufactured product, you're going to have to test and validate and verify that the product that you're constructing is meeting the specifications. Is it safe? Is it sound? And that's what the pre-closing and the post-closing QC does. It sets it up. You want to verify or validate your information before that loan closes, because after the loan closes, it's kind of a done deal at that point in time. It's hard to fix things at that point. So the pre-closing becomes more and more important as we go through the process. The QC function itself, be it pre-funding or post-closing, should be outside the production line. And they should be reporting directly to the president, CEO, or the board of directors, because they're the lifeline to that senior management. They're telling them what's going on within the company and whether or not there are issues being found in pre-closing or in the post-closing piece.
And so, you talk about that as far as being able to report to the presidency directors. And obviously in our industry, we have companies that are all different sizes. So from your broker, who may be an individual, to your non-del, to your bankers, to your wholesale lenders. So how should a QC plan look like within different organizations? What characteristics should they be looking for when they're putting together their QC plan?
Yeah, unfortunately, there's not a one-size-fits-all type of QC plan. They should all have the same structures, but it's all going to be on various levels. Of course, if you sell directly to the agencies, sell directly to Fannie or Freddie, or you're an FHA delegated underwriter, your plan and your QC process has to be a lot more robust than someone who is just a retail lender and they're not selling directly to the agencies. If you only originate in one state, your plan doesn't necessarily have to be as robust as the lender who is lending in 50 states. So you have to look at the size and structure of the company, and the geographic areas, the volumes, and the mortgages originated. If all you're doing are hybrid ARM loans or some risky type product, you're going to have to define that and have it a little bit more risk layers involved with that. But if you're doing plain vanilla 30-year fixed type agencies loans, then you're going to structure it to that point. The origination sources, that aggregator, the one that like the Wells Fargo of the world, they're a bank, they're an aggregator, they're putting the loans into pools. They've got to have a much bigger, more robust QC plan and QC process than the retail lender or the correspondent lender that's selling up to the aggregator. So if you just think about the waterfall of how the process works, you've got your wholesale lender who's also originating on a retail basis. So they've got to have a plan that would address both wholesale and retail. You've got the correspondent. Your mini correspondent has to have a QC plan, and it has to incorporate what the functions are that they're doing within their operations. And then you've got the mortgage broker. And this is a question that I consistently get is, does the mortgage broker have to have a QC plan? Well, the answer is yes and no. And I lean more toward the yes, because how does the broker of record know what's going on within their operation if they do not have a QC of what's happening within their own house? So there's a plan. It's scalable to the size of the company and to the size of your process. So you just can't pick up a QC plan from the internet and just say, okay, this is what I've got. You need to have it customized to your own company and to your own specifications.
Well, and that really goes into, our next slide we're talking about is, QC plan provides a company with the ability to actually detect where these issues are. And so how can they do that? So identifying the root of the defect and whether it was pre-funding or post-closing. And so why did it happen? Who's responsible? So how can they manage that to make sure that it's not just a QC plan that's in the drawer? It's just like policies and procedures. They actually have to be implemented. They have to be monitored. So what are some of the things that they should be doing with that?
Well, and that's the important piece. And that's, your plan has to call for, it's the written structure of, what your defects are you seeing? It goes to the same typical who, what, where, when, why, and then how are you fixing it? What's the defect? How did it happen? Why did it happen? You have to go back to the responsible party and say, okay, why did we not collect the verbal verification of employment prior to the loan closing? who was supposed to have done that? And the typical answer that I normally see is, well, underwriting was going to do it. And then the underwriter says, well, the processor was going to do it. And you've got a cross of, who was supposed to be doing it. And ultimately, nobody did it. So there's a problem there. So it's going back and say, okay, now we need to define who's responsible for doing this, taking care of this issue. And then, now you've defined it. Okay, it's occurring in these two areas. So now we've got to fix it. So you've got a corrective action. And that's where management comes in. They need to know about what's happening. They need to set up the corrective action that goes along with that. And then there needs to be follow-up. The deficiencies that show up in September should not be occurring again in December, allowing for some lag time for you to fix things. But in between September and December, there should be some sort of follow-up or documented that saying, okay, we are working on this issue and it's correcting itself. It just has to get through the channel. So again, it's the who, what, where, when, and why, and then how are we fixing it? What are we doing to fix it?
Right. And the agency requirements for that too, right?
Right. They're looking at, they're now requiring pre-funding. And the whole purpose of the pre-funding QC reports is what they're trying to do is to prevent large issues or big issues falling in after the loan is closed, because they don't want to have to put a loan back to you to repurchase because the verbal verification of employment wasn't done, or something that was required to be done didn't happen prior to closing. They don't want to send that loan back to you. That costs them money. And for every time somebody has to touch that loan after the loan closes, it's a cost. It's a cost to the company. It's a cost to the investor. So they're trying to mitigate that. So that's why they said, okay, well, we want to push it more to the front. If we can fix these nitpicky little issues at the very beginning, it's going to solve our big issues in the back end. So Fannie and Freddie and FHA now require the pre-funding to happen prior to closing. Now, the one big deal with FHA is that they require that to be pre-funding to be done after the DE underwriter has underwritten the loan. Well, that's going to pose a problem in that you have to figure that into your timeline, because I see a lot of loans that are going to, the underwriters approving them on Tuesday and it's going to closing on Wednesday. That doesn't give you very much time. So you've got to allow for your timeline there. And that's where management comes in. Are they allowing for this timeline? Your post-closing audit. Basically this is verifying and validating that all the functions within the origination cycle have been done properly. It's more than just looking for fraud. That's what the whole process used to be. But now it's really looking for all the T's crossed, I's dotted. It's the credit documentation there, as well as compliance. That's the piece that has to be looked at as well. They're looking at the CD. Was the CD completed properly? Were the notes, was it notarized? Do we have everything that we're supposed to have in that loan file? One of the new features that FHA requires is that a post-closing QC credit report be run, very similar to what Fannie and Freddie require. So that's now a new requirement. That
it's important to stay up on all of those things. Right, so it's important to stay up on all those. And so we talked about the why, so now let's talk about the how, and you put together a QC plan. So the first step is to have a plan. What does that look like?
So primarily it's got to be in writing. What do you want to do? And again, going back to your own corporate structure, how are you selling the loans? How are you originating them? What's your geographic area? What's the plan? How are you going to look at this? So you get that, you put it into writing, and then senior management has to sign off on it. It needs to be approved by senior management, and then it needs to be implemented. Too many times I see companies will get a QC plan and then it goes in the bottom drawer and never to be seen again. Those days are going away, because one of the first things that the examiners are looking for is, show me your QC plan. Show me what you've been doing. The QC plan is going to specify the details of operating and reporting procedures for all the employees involved. It's going to detail out re-verification processes. There's certain documents that have to be re-verified. The credit reports, the field appraisals. What do you want to see in the QC, and how are you going to review it, and then how are you going to report it? So it's putting all of that into writing.
Right. So having the plan is important, but also one of the things to have is random sampling. So why is a sample selection process for random discretionary loan selections important?
Well, you've got two processes that you've got sampling for. You've got the random sampling, and each of the agencies have a criteria for that. They call for 10%, or depending on the volume that you have. Typically, unless you're a big lender, you're going to run for 10% of your sampling. And and within that sample, you want to pull make sure you're capturing different loan originators, different branches, different processors, different underwriters, different closers, so that you're touching somebody and some type of loan at least once a year. You're getting that good view of what's happening within your operation. The sampling process, it really provides a snapshot in time. With proper sampling, it's going to provide you with a picture that's going to indicate where you would need to make some changes. It's not possible to QC 100% of your loans if you have any kind of volume. Well, it's possible, but it's going to be very expensive. So you want to take a sampling of that, and it should give you a picture of whether or not you've got some issues or not. So you want to change that sampling process on a relatively regular basis, so that you are picking up and you're getting a view of the overall structure.
Yeah. So looking at the QC personnel, though, so what kind of responsibilities? We're talking about, obviously sampling and monitoring and reporting and all those kind of things. So what is a typical QC person's responsibilities?
Well, the main thing is they've got to know what each department does and how they do it. They're going to have to maintain and disseminate up-to-date information about company requirements, as well as the investors and the agencies. And then they also need to know the regulatory requirements. The company has to ensure that the people reviewing the files for QC, that they are knowledgeable, that just the use of a checklist is not going to cut it. You need to know the more granular requirements of a loan, how to underwrite a loan, because really part of the QC post-closing is re-underwriting that loan. Did they calculate the income correctly? Did they calculate the assets correctly? Looking at an appraisal, that takes some skill level. Checklists are great. They're good reminders, but they're not the all-encompassing. And then you've got your QC people have to be able to report directly to senior management and let them know what's going on.
Well, and that really, what we're seeing now, and so much of this is an increase in detecting any kind of issues. You talked about at the beginning that QC used to be to detect fraud, and now the trend is to really to mitigate risk. So one of the things, obviously, detecting fraud, but really to be able to mitigate risk in selling those loans. So that's such an important trend in what we're seeing in our industry today. So how does the tracking of all of this take place?
Well, and again, it's the tracking and trending is really the important piece of this process. It helps management to identify those issues where there are deficiencies. And I had somebody, and I like to put this in here, the areas of opportunity. Rather than calling it a deficiency, it's an opportunity. It's a learning opportunity. And I've always thought that was a very nice way of putting it. But it is, you know, most people hate the trending and the tracking and the QC reports because it's like a report card. I don't know about you guys, but I hated getting report cards because, you know, I usually got in trouble with them. But the tracking, it tells management where issues need to be adjusted. It tells them good things. It tells them bad things. It's a proactive rate measurement. So one of the things, it's really important to get to that senior management, these tracking reports. The other piece to it is that the examiners and the agencies and the investors, that's one of the first things they want to see is where's your trend, where's your tracking. If you see a consistent trend with a deficiency, the next question is going to be, why haven't you fixed this? Why are we still seeing this? And that would be a hard question for management to answer if they don't. They need to have the set answers. So it's letting management know where the hurdles are, right, where the alligators in the pond are.
Well, and making sure, too, that those changes are made because, you know, the examiners, they don't expect for you to get 100% of it right. They know that there will be errors because that's just nature, human nature. It's the nature of our business. But what they want to know is, as you said, is what are you doing to detect it, identify it, to report on it, and to correct it, and to make sure that management obviously is involved in that process. So really it takes us to ignorance is not bliss, right?
That's exactly it. You know, just hiding behind blinders is not going to work for you, nor is it an excuse. You know, I don't know when an examiner asks you a question about a QC process or of something that's showing up in the QC report is not an answer that they want to hear. You know, I don't know. It's not a good answer. You know, I keep thinking it's like somebody at Samsung probably didn't do a good QC process on the Note 7. So that's coming back to bite them.
First time or the second time, yes. My son had to return
That's right.
that. Yes, yes, yes. Which takes us to the next which is the third-party vendor review, or what you call the QC of the QC. So let's talk about this review. How often, who should be doing it, and what should they be doing?
Yeah, a lot of the companies are outsourcing QC, which is a very cost-effective way to do it. Because if you are doing QC internally, that's an expensive process because you got to have a full department doing it. So why not outsource it to a company that's all they do is QC? So they have all the tools, they have all the personnel, so outsource it. So what you have to do then is validate what they're doing. You know, with the agencies, you've got to, you know, you've got your vendor management. You've got to go back behind and then sample what that QC vendor has reviewed, and the requirement for Fannie and Freddie is 10% of those outsourced QC reviews to be reviewed once again by someone internally within your company, just to make sure, did you catch the same things that the QC vendor did? If not, then you write up a deficiency for them, and they have to have the same process that you go through. You've got your reporting, you've got your tracking, you've got your corrective actions that your vendor needs to go through. The main thing is that the lender is required is responsible for the entire QC process. So if something is missed on that third-party review, that's kind of irrelevant. It's totally in your wheelhouse. You're responsible for it. So you want to make sure that you're going back and making sure that they're doing what they're supposed to be doing.
Right, which brings us to our next topic, which is reporting procedures. So when it comes to reporting, what methodologies, distribution, response, and resolutions to the findings should a company be using?
Again, written reports. You want to provide reports that are useful to internal management. I see QC reports that are 300 pages long. And they're not that many loans. Are they useful to management? Yeah, they tell a very good story, but who's going to sit down every month and read a 300-page QC report? You need to break it down for management. It has to be in writing, and it has to identify those critical components that are included in the reports and distinguish whether or not they're credit-related or are they compliance-related. And that's an important distinction because they carry two different risk levels. You've got to have the same reporting structure for both pre-funding and post-closing, and it has to be done on a monthly basis. Senior management needs to be made aware of it on a monthly basis. And one of the important things that I really recommend is that the QC reports be summarized and reported to senior management on a monthly basis so that when the senior management has their meetings, their board of director meetings, it's reported, it's within the minutes, you've got it documented, that's QC reported up to senior management or the board of directors, it's in your minutes, you've got the findings, you've got the corrective actions. That then tells the examiners what, one, it evidences that senior management is involved, and it documents that participation, which is a really important feature these days.
Right. So we have a lot of going on as far as the QC and reporting and things we need to do, but what are the requirements as far as actually retaining the documentation for the files? What should a company be looking at?
Okay. Well, different agencies, as you can see, Fannie and Freddie require 3 years. And when they say retain all the documents and records of the QC findings, they're talking about the work papers of the QC review. So you have to keep those records for 3 years. And then you've got to have the reports that for 3 years. And then any kind of corrective actions you keep for 3 years. So the agencies require 3 years. But FHA has now stated they want 2 years. I'd readily recommend 3 years since you got to do it for agencies. So if you just set it out at 3 years, then you're kind of good. But again, it's going back to who did the review. You're documenting who did the review, what did they review, where was it reviewed, was it outsourced, was it done internally, when was the review performed, and for what period of time, and then why was the review performed? Was it random? Was it discretionary? Was it because of an early payment default? All these reasonings have to be documented and then retained for that period of time.
And then that ties back into your policies and procedures as well, Theresa, to make sure that what you have in your policies and procedures that you do for QC, that you're actually doing, right?
Correct.
So that gets us to our next topic, which is audit and review. And so really, you have to ask yourself, in your QC plan, when was the last review of your QC plan? So what you're looking at, how often should a QC plan be reviewed?
You should review it at least once a year. And one of the things that I look at is if it hasn't been reviewed in less than a year, then it should be updated. Particularly, we've had so many changes in the last year with Fannie and Freddie and with FHA. So you've got to really, I think the last Fannie Mae update was in June of 2016. So you have to make sure that it was incorporating that into your plan, particularly if you were an agency approved lender. FHA updated everything as of September of 2015. So again, looking at it, you have to look at it on an annual basis. The audit has to include, your net and gross target rates. That's a requirement of Fannie now. And the target rates, people kind of ask me a lot of times, what does that mean? Yeah, in a very simplistic way, the gross target rate is basically what's the percentage of errors that you would allow from a pre-funding that can be fixed prior to closing. And then the net is basically what's the percentage that you would allow after your loans have closed. What's the error rate that you would allow? And this is for material findings. And from Fannie Mae's perspective, a net finding, which is a material finding, means a loan that's going to be repurchased. So if you think about it, how much can you afford to repurchase? You know, the net process is going to be pretty low, more than likely for most companies. Your plan has to be updated to include sample selection methodologies. That sampling may change from time to time because of your product structure or your geographic locations. You know, does the plan include early payment default requirements that are required by Fannie, Freddie, RHS, and FHA? What about self-reporting? Self-reporting is a big deal these days. The agencies are looking at, you know, are you telling the agency if you see problems? If you see problems, you're supposed to report it to the agencies. Does your plan call for another QC if you were QC vendor? So all of those are features that have to be incorporated within that QC plan and updated on a regular basis.
So it brings us to the overall capabilities of a QC plan then. To wrap all of this up, it should do what?
Well, it's got to incorporate the evaluating and monitoring of the overall quality of your origination process. You know, again, going back to who, what, where, when, why, and how. You know, how is it done? And it has to be done on a regular basis. It has to be done timely. All of the agencies now require that the QC reviews be done on a monthly basis. It's really no more of the, oh, well, we do it on a quarterly basis. You can't really rely on that any longer. They want to see it done monthly so that you've got a monthly report on the previous production if it's post-closing. The timely reporting is important. If you're a Fannie Mae approved seller and you're outside that monthly review, you're supposed to self-report that. You have to tell on yourself. Say, okay, well, we're running late. You know, give me some slack here because we are running late, and this is why. So, and that's one of the findings that they'll come back to you on if they find that the QC reviews are not being done in a timely manner.
And really you want to do that anyway, because if there is an issue, and it may just be something as simple as a training issue, you want to be able to address that, because you do not want to find out by the third month that you have a whole batch of loans that are not going to be purchased for a particular deficiency or something not being done. So for your own internal safety and soundness of your organization, you need to look at that. Now you talked about, Theresa, some of the requirements being a loan servicer. So let's talk about those right now.
Yeah, and again, everything that we've talked about today is really from the origination side. But if you're a loan servicer, you need to have a servicing QC plan. And the servicing QC is different than the origination piece of it. And it's a hot topic these days. CFPB has really been focusing in on loan servicers. So if you're a servicing entity, you really need to go back and look at your QC plan for servicing. That one also needs to be updated on an annual basis. And that plan has to incorporate reports and documents and the trending and the tracking of the findings within the servicing review. These are the first thing that the examiners are starting to ask for, whether it's an origination process or the servicing QC plan. The trending and tracking and the QC reports are a direct line of communication to that senior management. And this is the first thing that the examiners are starting to ask for. In both origination and on the servicing side, if you have an incomplete QC process, it increases your risk level exponentially. It's low-hanging fruit for any of the examiners to look at and say, okay, this is a weakness within your company. Your investors are also starting to look at this and want to see your QC plan, want to see your QC reports. And I think more and more of the wholesale lenders are asking the brokers for their QC plan for when they do their recertification, as well as the retail correspondent lenders.
Right, definitely a trend in that, as well as policies and procedures. So policies and procedures and QC plan, and actually I'm going to ask you the difference between that because I know you get a lot of calls on that. That's probably one of the top calls that I get besides needing training for an organization is I get a call saying, I need QC, and really, in addition to QC, they also need policies and procedures. So can you give just an overall, far-reaching, what's the difference between policy and procedures and a QC plan?
Well, if you think about policy is what, you've got it in writing, what are we going to do? I am making a statement of this is what I want to do, this is what I'm going to do. The procedures are this is how I'm doing it, this is how I'm implementing the policy. And really the QC plan is part of that procedure. You've got a policy that you're going to have a QC function, and you're going to follow the QC function, and you're going to report to the management. The QC plan is the tool, the mechanism that you're going to be using to implement that policy of having a QC plan. So it kind of goes hand in hand. It's a subset of the procedure. It's the procedure of implementing that QC policy.
And how they all go together. So if you have questions today, and I'm not seeing anything right now, Theresa, but if you do have some questions from what we've talked about today, feel free to type those in the question box. And if we can't address those today, then we can certainly reach out to you and answer those questions individually. We have provided you with a variety of resources that can be beneficial for you as far as putting together your QC plan or even updating. One of the biggest challenges we have in the industry is not just having a plan in place, but making sure that it's up to date and as changes come along. And that's really one of the greatest benefits of Strategic Compliance Partners, SCP, and what they provide is the ability to have all of the tools you need for your policies and procedures, for your training, at a low fixed monthly fee. And so being able to kind of put that you can check that off of the checklist to have all of those policies and procedures, and especially just staying up to date on those, because I think those are the most important thing, is to make sure that all your policies and procedures are up to date. And so by engaging with SCP, you can know that those are kept up to date and that you can go ahead and implement them, obviously, into your organization. SCP has made available, if you're interested, a free risk assessment if you are not currently doing business with SCP, and if you would like a complimentary risk assessment, you can click on the link there, or you can go to strategiccompliancepartners.com/realtime-risk, or you can email them for more information to info@strategiccompliancepartners.com. And before I move on, Theresa, I am seeing a question in here. I don't know if you're seeing it and want to address that.
So it's like, the question is, how long should a pre-funding QC take? Well, it's kind of like, how long will it take to underwrite a loan? If you are looking at a loan that's not very difficult, it shouldn't take very much time at all. You've got a very short time frame that you can take on reviewing the loans. I would say it's hard to put a time frame on it, but it's going to take about the same amount of time that it would take to underwrite the loan. So, it doesn't take days or weeks or anything like that. It should just take, really an hour, possibly. And then the adjunct to that, can the compliance officer handle the pre-funding QC? Yeah, if they have the qualifications to do that, they could do that. Particularly with smaller companies where you don't have a lot of personnel. You've got people that are in handling multiple jobs. The compliance officer would be a good fit there because they do report directly to senior management. They're outside the production line. So handling that pre-funding piece within that position, I see that happen a lot, particularly for smaller companies.
Right, and that's so important now too, to be able to have individuals that can manage a variety of job functions, but then also to know when to outsource certain job functions, to be able to say, okay, we don't have the bandwidth for that, it's not in our wheelhouse, and so we're going to outsource that. So just like with strategic compliance partners, to outsource a portion of your compliance to them. And then also for myself, I'm an education specialist, as I said, and so for a lot of my clients, I'm actually their training department. And so I help them to develop their training, whether it's their VA, their FHA. I know I have a client, I'm actually creating all their VA training for them right now. Just finished their FHA and then moving on to their USDA, because they aren't big enough to have a training department, but they're at that point where they need training. And so I'm working with them to do that. And so it's important to know when you're managing your business on the overall QC, on a compliance area, and on your training, sales training, product training, things like that, where to be able to reach out for help, because those are the areas that we can help with. So if there's something I can help you with regarding your training needs that are outside of what Strategic Compliance Partners offers for compliance training, then you can email me at ginger@Go2Training.com, and I'm happy to help. So our next webinar will be in November. It is on Thursday, November 10th, and we will be talking about the changes, which we're going to be talking about for a while. It's going to be our focus, obviously, in 2017, but we wanted to get started there and to let you know, what do you need to do to start getting prepared for this. So you want to get registered for that webinar. And Theresa, I want to thank you so much for your expertise today. I always learn so much when I have you on a webinar, so I want to thank you for that. And I want to thank all of you who are attending today, and we wish you all a happy holiday season, whatever holiday season you're in, and we look forward to seeing you all in November. So have a great day.